Hey everybody. This is a mini lecture looking at chapter 13 from Econ 132, talking about property taxes. And what we're going to do in this chapter, it's chapter 13 in the Fisher textbook, is just look at the institutions and structure of property taxes, which is not the most interesting stuff, but it's a short chapter just giving you an overview of how property taxes work if you're not familiar. And a lot of people aren't actually that familiar with it. And so that's what we'll talk about, is just sort of the general information about how property taxes work, how they are assessed, and the different policies in place surrounding them. And then that will be a great segue into chapter 14 when we start talking about property tax, income tax, and sales tax revenue. And all this is piggybacking on what we talked about last time in class, which was taxes generally, the inefficiencies of taxes, the burden of taxes, who bears the incidence, and the ways that we can see taxes generate those inefficiencies, that deadweight loss, or as the textbook calls it, excess burden, and how to avoid taxes, and how it all comes down to elasticities. So what I'm going to do is go ahead and pop up the slides for chapter 13, and these are on Canvas. If you're enrolled in Econ 132 this semester, it's the chapter 12 and 13 slides, and then we'll get through all of this material and be ready to talk about tax revenue. Sound good? All right, let's go. All right, so chapter 13 looks at the institutions and structure of property taxes, which is basically just looking at the background and giving some foundational understanding of property taxes before we talk about the economics of it. And so this is why this is kind of a boring chapter, but it is interesting in the sense that property taxes aren't necessarily, they are one of those taxes that's not necessarily well understood, and so that can be interesting. The other thing that's interesting is this quote here from the textbook, which says that in 2019, the Tax Foundation, basically they did a poll and asked people to rank taxes from very fair to not fair at all. And the majority of people contacted identified property taxes as very unfair, second only to estate taxes. And so one of the questions we could ask is, why do people hate property taxes, right? Why do they see them as so unfair? And understanding the structure of that is going to help us. So we're going to look at property tax trends over time and our reliance on them, state and local government reliance on them. We'll look at the process. We'll talk about how property is assessed, and then we'll talk a little bit about property tax relief. And like I said, this is a pretty short chapter, so we're just going to kind of go through these elements as quickly as we can so we have a sense of how property taxes work, and that's going to help us understand the economics of it. So the first thing is that looking at where the property tax revenue goes. Majority of it goes to school districts, which is what we have a sense of already, right? That property taxes pay for schools. Some goes to special districts, townships, some goes to municipal government entities, some goes to the county, and some of that revenue does go to the state. And we can look at in class together a breakdown of that in Sacramento County to get a sense of it, because basically what it is small percentages of the total property tax rate will be pre-assigned to those sources, to those destinations. We've also seen an increase in we've seen a decrease, in the percentage of property taxes as total revenue over time. So it used to be a large portion of state and local government revenue, but we've seen it decrease in its role for special districts, for school districts, townships, municipalities, and counties. So a decreased reliance on property taxes in the local government over time since the 60s. And then this is the tax process. And this is one of those weird things. And so these charts, these flow charts, are meant to be clear and make a complex thing more obvious. I don't know if they always achieve that. So we're going to talk about it 2 times. And hopefully that helps it make sense. And if not, we'll review it together in person in class. So when we're talking about the tax process, we're going to have rules that are in existence, usually set in place by legislation or by a vote on a ballot measure. And then we're going to have the role of the agent over here. There are assessors and tax collectors and ruling bodies that have a role to play in this process. And then we have the variables that are being measured. And so the first variable we start out is the fact that there's an actual market value for a property, right? A house has some market value, right? You go on Zillow, you look up a house and you see, okay, it's worth $600,000. That's the actual true market value. Based on that market value, an assessor applies an assessment ratio rule to the property. And so the idea here is that the market value is not necessarily the same as the assessed or the taxable value of the property. So the true market value is one variable, and then based on the assessment rule ratio, based on certain exemptions about what parts of the property might not be taxable, whatever the assessor's rules are, there's going to be a different value that's the assessable or the assessed or the taxable value of the property. So if the house is worth $600,000, the assessed value or the taxable value of the property might be $500,000 because of some exemptions. Once we get that assessed value, then we have to know what the tax rates are or what the tax limits are. And that's decided by either a legislative body, elected officials, or by some referendum, something that people voted on. And that's true, right? We see that. We know that we have limits on property tax rates in California based on a referendum that was voted on. California residents voted to tax the assessed value of property at 2% growth annually. And so that gets to this idea that there's a true market value, and then there's that assessed value, and that's going to be limited by the rules that are put in place by that referendum. Does that kind of make sense? So we have the real value, we have the assessed value, and then we have the tax rate that tells us what the property tax levy is. And that's what the tax bill is. So there's some bill that a homeowner is charged, that's their property tax bill. And then the tax collector is the agent that comes in and turns the property tax bill into property tax revenue, right? Collects the money and gives it to the local government entity. And so the process we have in place is that there is some real value or real market value of the house that is then turned into the assessed value, which is then turned into the property tax bill, which is then turned into the property tax revenue for the government. And that's done through a combination of rules and agents enforcing those rules. Hopefully that makes sense. We'll talk about it one more time. This is not something you want to memorize. It's just something you want to have a sense of in the back of your mind as we talk about property taxes. In terms of the property tax process, property tax is historically measured as millage, which is just a unit of measurement. It's one of those old measurements, right? Like a yard is kind of a weird unit of measurement. But 1 mil is 1/10 of 1% per $1 for each $1,000 of taxable value. And so we can break the millage down, or we can break the dollar amount down into where those property taxes go. And so that's just another thing to think about in terms of the terminology used in property taxes. This word millage is a measure of how much value a property has and how much it should be taxed. In terms of assessment, we can think about assessing the value of a house as being the same as a hedonic price function, if you remember those, or if you're familiar with that, or as like a regression equation, where basically what we're looking at is there's some base value that the land has. There's some value that's based on the square footage of the house, so each square foot adds $75 to the value. Some value associated with bathrooms, so each bathroom adds $18,000 in value. Each bedroom adds $4,000 to the value of the house, and the number of stalls in the garage. 1-car garage is $4,500. A 2-car garage would be $9,000. A 3-car garage would be 10, 11, 12, 13, 14,000 or 1350. And so in this case, one way of assessing a house is by looking at a weighted average or a weighted summation of the features of the house. And that's what a hedonic price function does. It says, hey, let's take all the elements of a house, assign them a value, and then add them up. So a 1,000 square foot house with 2 bathrooms, 4 bedrooms, and a 2-car garage is going to have some value, based on inserting those values, the 1,000 square feet, the 2 bathrooms, the 4 bedrooms, and the 2-car garage into those variables. Does that kind of make sense? This is basically the form of a regression equation where we're inserting values for our independent variables, our explanatory variables, in order to get an end result, a dependent variable, a variable, in this case, value of house, that is dependent on all of these other features. Assessing the value of a home is complicated. There's not just one way to do it. The book has the Assessors Poem in there, and so I thought that'd be a fun thing to add in. To find a value good and true, here are 3 things for you to do. Consider the replacement cost, determine the value that is lost. Analyze your sales to see what market value really should be. Now, if these suggestions are not clear, just copy the figures you used last year. This sounds dorky and quaint, but this is a summation of the 3 methods of assessing property value. So the first is comparative sales approach, right? Use the sale price of a house with similar features. So if I've got a 3-bedroom, 1-bathroom house built in 1969 that I want to assess the value of, and down the street, a similar house, 3-bedroom, 1-bath, 1960s built, is up for sale, I might say, okay, well, if that house is worth $550,000, then this house is probably also worth the same, give or take, because they have the same features. So if the market value of this house is $550,000, then a similar house would also be worth that much. Another way to assess the value of a property is to use the cost approach. And the cost approach is basically to say, okay, how much is the house worth historically? How much was the house worth last year? And then take into consideration depreciation. So if the house was worth $500,000 last year and no updates have been made, maybe now it's worth $490,000. Does that make sense? It might seem weird because we have a very strong history, especially recently, of houses increasing in value. But you want to remember that land appreciates, but homes depreciate unless you put more money into them, right? Things break down. And so without doing repairs, doing remodels, adding value in, we want to expect depreciation year after year. The last of the 3 methods for assessing property values is the income approach. And that basically says, how much income could this house earn if it was a rental property? So you use the present value of future net income that the house can generate. How much would this house be worth if I rented it out for a year? And how much income can it generate? That present value of that income can be used to assess the market value of the house. In terms of assessment, we also want to remember that many states limit annual increases in assessed value, but allow the properties to be fully reassessed at market value when they're sold. And we talked about this a little bit already, but the idea here is that if my house is purchased in 2020, I buy a house and it's worth $500,000. In 2021, the market value might have gone up to $550,000, but the assessed value is going to be capped at that 2%. So let's see. Get a calculator here. So if it's capped at 2%, it's only going to go up to $510,000. And then in 2022, it'll be the same. Maybe the market value went up more, and now it's worth $575,000, but it's going to be capped again at 2% growth Oops, too many zeros. And so now it's only going to go up by another 10,500. So the assessed value will be 5,220, even though the market value went up by a lot. And we can see this is actually happening in the real world right now. Market value for homes is going up by more than 2% annually. The assessed value, the value that the house is taxed on, is capped at 2% growth per year. So that's the assessed value, which is capped at 2%. And that's true in California, whereas this is the market value if you were to sell it. And if I were to sell my house, if I decide this house is awesome and I can make a lot of money, and so in 2021 I sell it, then the new owners have to pay taxes on the market value, not the assessed value. Does that kind of make sense, hopefully? We'll go over it again. We've talked about it a little bit already. We'll continue to talk about it because it's a big issue. This is one of those issues that's an ongoing concern in California, because that cap means housing is more affordable, right? It subsidizes home ownership in the United States. It provides a disincentive to move, and it restricts our property tax revenue. So there's pros and cons on it that we'll talk about more as we get further into the process. But the basic idea here is that lots of states do this. California does, not just for residential, but also for commercial property, but lots of other states do it too. So that's assessment. That is the big first chunk of property tax structure. And that's kind of the big idea I wanted you guys to get a sense of. There's a little bit more of the assessment of property taxes in the next slideshow, which looks at the analysis and effects of property taxes. So that's the structure of property taxes. It's not the most interesting thing, but I wanted to keep that video on chapter 13 super short, just so you can have a little nibble on what that chapter is about. The next chapter is more interesting because it talks about the economics of it, different ways of assessing property taxes, how property taxes might create inefficiencies and alter incentives. And so that'll be the next video I make, and then I'll just talk about property taxes a little bit more, and then we'll be all set to continue into new tax revenue discussions. So take a look at that chapter 13. Let me know what questions you have, and I'll see you all next time.